With this example, we're going to be looking at some practice doing not only adjusting entries, but our correcting entries as well for now that we're in this third week of financial accounting. So what I've provided to you, and at this point, you'll want to go ahead and pause the video because I've given you an adjusted trial balance, an unadjusted trial balance. So this is all the final entries, the T account balances as of the end of the year, except for the few items that we still need to adjust and or correct. So what you're going to want to do is kind of step back and put these accounts, get out a T account sheet and make a T account for each one of these accounts that you see listed, and I'll show you mine in just a second. And you'll want to, at some point here, pause the video and jot these down into T accounts. It'll really help you to go along as we progress through this example if you really want to learn this. I highly recommend that you go ahead, because otherwise it won't make a lot of sense once we get further on. And then, because our final step is to prepare the adjusted trial balance. And it's really hard to prepare an adjusted trial balance if you don't have updated T accounts. So what we're going to be doing using these numbers here, you're going to put these, I want you to practice putting these in from a trial balance back into T accounts. And I made sure that the equation's still balanced when I put these back in to make sure I put the numbers in the right spots. So for example, like cash, I had $12,000 in my opening trial balance, $12,000, and then I had an account payable. It's actually to Steve. I have the wrong name here. It's actually to Steve. Let's update that. We have prepaid insurance, prepaid advertising. So all of the accounts that you see there, I have listed here in my T accounts. And that's what I want you to do, to take the next 2 or 3 minutes and get out a T account sheet and update. And once you're done, we're going to begin to look at these correcting and or adjusting entries to finish up the year for this Julie's Design Company. Okay, so hopefully you have now updated all of your T accounts, and we're ready to get started with doing this first adjusting or correcting entry. And we'll see on this first one that it's actually going to be a correcting entry. So for number 1 here, Julie required payment in advance for the billboard design for Sears. However, she's not going to complete the project until sometime early next year. She did, however, receive the payment the last day of the year in the amount of $2,500. Now, how she recorded the entry was a debit to cash, which makes sense because we did get the money as of this year. And she made a credit to sales revenue for $2,500. That would be the incorrect part because we're not doing the work until next year. So I need to go in and do a correcting entry. I don't want this to show sales revenue. If I go back to my opening trial balance, that sales revenue of $2,500 is in this amount here. The $17,000 includes that $2,500 I just put in. Actually, it was probably today I put it in December 31. But I need to go in and take some of that out. So let's look at that first entry and what I'm doing. So I'm going to pick the method number 1 that I discussed in the previous video, and I'm just going to simply do a reverse of the incorrect entry and then show the correct entry. So the incorrect entry before had a debit to cash and a credit to sales revenue or service revenue. So I just want to reverse that, zero everything out and pretend it didn't happen. So debiting my service revenue to knock out that previous $2,500, even though you can't see it, it's in this number here, the $17,000. And then credit the cash and pretend like that transaction didn't happen now. And now go in and do the correct transaction. Go ahead and put the $2,500 back into cash because actually it was correct, the debit was. And then credit my unearned revenue. But notice it's for Sears. So I want to make a new T account for Sears. I don't want to put it in the Bistro account. Just like with an account payable or account receivable, I want to keep a separate heading separate T account for each company that I owe money to. So I put the $2,500 here as a liability instead of in the revenue. Now you could have done the quick and dirty way and simply not have provided the journal entries for the cash, since they cancel each other out, and simply had one correcting entry as a debit to service revenue and a credit to unearned revenue, and then you wouldn't have had anything here, because our final balance is still going to be $12,000 in the cash. All right, let's look to number 2. Julie last paid her employees on December 14th. Okay, that's old information. Our employees have now worked for these last 2 weeks and will be paid early next year. All of the employees' earnings were $1,500 up through the end of this year, and they will be paid $1,800 on January 2nd, which will include their holiday pay from January 1 that they're working overtime. So what we want to do is, we need to record something here because work was done. Even though a payment hasn't been made, that's irrelevant. With an adjusting entry, we have to record an entry when work has been done, even though payment may not have been made. Now, this is extra information right here. Don't let this throw you off. The $1,800, that's next year. What I care about is how much work was done right now. And there's $1,500 work done. And so then we got to think, what did the business get? We got the benefit of our employees working. And so whenever the business gets a benefit of something, we automatically want to think of an expense and then see if the expense rules work. So the first question to see if something is an expense, are we using the benefit this month right now? And the answer is yes, we used our employees this month in December. And will I be using this work that they're doing right now for the whole next year? The answer is of course not. It's only being used right now. So this would be an expense, and when our employees work, we call that a wage expense. Now, with our credit, we don't want to call it cash because as of December 31, I have not paid anybody. So I want to create a liability account showing that I owe money to my workers. And that's what's happening here. So we debited our wage expense account to show that an additional amount of work was done, $1,500 worth as of December, and show now a brand new account called wages payable in our liabilities. So I'm going to add a new liability account down here. I'm going to call it account 220, wages payable. I credited the $1,500, and I come over here to my wage expense and add in that an additional $1,500 has been worked. Okay, let's go back and look at number 3 now. Julie's equipment has a useful life of 10 years. This is extra information for right now. We'll get into this later on in the semester, but I wanted to put it in there to kind of begin to introduce you to what it means that it has little or no value when we plan on selling it or getting rid of it. We're depreciating on a straight line basis, which is the only way we have learned so far. And I've put in here that this is the 3rd year of the equipment's life. We'll be able to know that just by doing the process that is correct. Now, the only thing we can think about here, though, is, well, how much did I use my equipment? I don't have a number to work with. Well, that's where I want to look at those opening balances. I'm going to go back to the one we just did, and I need to go down to my equipment. My equipment has a balance of $15,000. If I'm using my equipment over 10 years, I want to take that $15,000 and divide it evenly over 10 years. So that's $1,500. And remember, I said this was the 3rd year. Well, here's my first 2 years. I had $1,500 year 1, add in $1,500 for year 2. Now I'm ready for year 3, and I'm going to put in another $1,500. So this would be the journal entry. We ask ourselves, what did the business get? Well, we used our equipment. When you use equipment, something in your assets, the long-term assets, We call that depreciation expense. We don't call it equipment expense, and we don't take away from the value of my actual piece of equipment. I'll show you that in a second. What I want to do is first is create a new depreciation expense T account. Notice it's the first one. I don't have a previous $3,000 in my depreciation expense. If you remember back to previous lecture examples that we have done, remember revenue and expenses get closed out every year. They revert back to zero, and their amounts go to retained earnings. And we'll talk about that next week. But since they do get closed out, I started over with zero. So this year, all I have in my depreciation expense is that $1,500. And now the credit, well, that comes over here to my assets in my contra account. Remember, we have one of our two contra accounts that we've looked at so far this year. And I put the credit there to increase, because this is the contra, so it's a minus plus. I'm increasing my accumulated depreciation. Key word here is accumulated, so I keep adding up all of my amounts. So total, I have used $4,500 worth of my equipment based on the balance of $15,000. Notice there was no credit here in the equipment. If I would credit the equipment, it would appear that I have either thrown away some of the equipment, sold off some of the equipment, and of course that's not the case. All I've done is use the equipment. So I always keep that balance set where it is, what I paid for it at the beginning, $15,000. Okay, we're ready for number 4. Julie finished up her project for Bistro this month. Well, without giving us an amount, I've got to go into my T accounts and figure out where would I look for a project that has not been completed before now, but now is. So I've got to find somewhere that I owe somebody a service. And if I look back on my previous example, I want to first off look in the liabilities. If I owe somebody something, it's going to be here in the liabilities. And I'm going to look down till I find an unearned revenue for Bistro. It appears I owed them $1,000 of service. So at some time in the past, they had paid me money, kind of like a gift card. If you were to go to Texas Roadhouse and buy a gift card, you paid money, they got money, but you didn't get a service yet. They just gave you a card that says you get a free service sometime in the future. And that's what's happened here. Bistro has paid my company money, but I haven't done the work yet. Now, as of December 31, I actually have done the work, and so I need to show the adjusting entry. The first thing, what the company gets as our debit question, well, we got a reduction on our balance of what we owe Bistro. It was actually a complete reduction. We don't owe them anything. And the reason I don't owe them anything is because I've now done the work. So I wanted to show in my T accounts here, I have now removed that $1,000 that I owed. It's now gone. That account is essentially zeroed out. And I put that $1,000 now over here where it belongs in the service revenue, where it will remain now, because the job is complete. At any point, you may want to update and make sure your equation balances, although I'm not going to be doing that in this example. Number 5, final count of our supplies shows $1,300 remaining. Okay, let's go back to the one we just did, and let's go find our supplies. Remember my assets, I kind of curve them down because I don't have enough room to list them all in a nice straight line. It would be too long. So the red line here shows the end of my liabilities. We're back with assets. Supplies, I have $3,300 still sitting on my books. If I didn't do an adjusting entry, my supplies would be too high. I don't really have $3,300. It tells me in my example that I only have $1,300 remaining. So if I have $3,300 to start, but when I'm all done, I only have $1,300 as a final total, I need to figure out how much did I actually get rid of as a minus that I need to take out of my supplies. Well, if I have $3,300 and I get down to $1,300, the difference, hopefully you see, is $2,000 of supplies I used. So what did the business get? We got the use of supplies. We actually used them, so we're going to call that an expense. Add that into my supply expense that I already have started. And then credit my supply account. And that should be $2,000, not $1,000. And come down and update my actual supplies and show that we have removed $2,000 worth. I'll total these accounts at the end, but I want to save room in case there's anything else that involves supplies. Number 6 and 7, I'm going to kind of do those together, but we'll look at number 6 first. So back on number 6, we originally paid $3,000 for insurance. That was in November. Out of that $3,000, $800 was immediately expensed for November. So if I paid $3,000 and $800 of it was used for November, hopefully you can see that I should have $2,200 left in my prepaid. And if I look back, I do have my prepaid account showing $2,200, so that makes sense. Now, it's December, the end of December, and I've used another month of my insurance. So I need to expense out another $800. And that's the first thing that I'm doing here on number 6. I'm showing that what did the business get? We got the use of insurance. How did I get it, or where did it come from? It came from our prepaid account. I didn't actually pay any more. I'd taken it out of my prepaid account. I'll look at the P accounts in just a second, but let's look at number 7 as well, since they are very similar. So here we were looking at prepaid insurance. Now we're looking at the prepaid advertisement, and it's noted that all of it was used up. So if I look back at my prepaid advertising, I had $1,100 coming to me in the use of advertising. Now it's all used. So I'm going to want to get rid of that $1,100 in prepaid advertising. If I don't, then my prepaid is going to be too high, and my expenses are going to be too low, because I should have $1,100 now over here in the expenses, because I have gotten the benefit of it. So that's where my debit and credit come from. My advertising expense, what did we get? The business got the use of advertising, and it came from my prepaid advertising. I've already paid cash at some prior point. Okay, so now we can update our T accounts. I removed the $800 from my prepaid, removed the $1,100, all of it, out of my advertising, and I put them over here in my expenses. I had to make a new advertising. I didn't have a previous advertising expense. And I need to update my insurance expense. It's now up to $800. It's now another $800 added in. Okay, my final transaction is another correcting entry. The first and the last one happen to be correcting entries. We looked at our bank rec, and we were comparing checks and amounts, and we wrote a check for Julian for $800. However, even though we used the correct accounts, we mistakenly put it on our books for $1,800. Well, before we get too far into this one, let's first look back at our account for Julian. So we owe Julian money. That should be an account payable. And it shows here that we still owe Julian $300. Well, obviously, hopefully it's obvious, or it becomes obvious here in a few minutes, that we owe Julian more than that originally, because this $300, well, that included now the mistake. Because if I put this in here, $1,800, pretend that $1,800 back in whenever date it was, maybe early December, we put in that we reduced our debt to Julian by $1,800, bringing us down to a final balance of $300. So we originally then owed, as you can hopefully see here, $2,100. But I took off $1,800 when I really shouldn't have. I should have only taken off $800. So I'm going to do this my first method way, where I simply do reverse entries and then do the correct entry second. And that's what you'll see here in my last example. So what I'm going to do is pretend that that original entry, the accounts were correct. So if we think back, the incorrect entry would have been I reduced my debt, so that would have been a debit to my account payable for $1,800, and I would have credited my cash because I paid money. But I put the wrong number. So I want to go back and just reverse that entry. So I'm going to put the money back in my books temporarily, $1,800, put it back on my account to Julian, $1,800. And so that squares it, puts it back to zero, like that transaction never happened. So now I'm back to owing Julian that $2,100. Now I do the correct entry. I show that what did the business get? We actually got a reduction on our debt, but for only $800. And I got a reduction in my debt because I paid cash of $800. Now, once all of the transactions are complete, there's always two things you always have to do before we want to move on. The first thing I want to do is total up anything, any key accounts that need to be totaled. So cash, when it was all said and done, it went up by $1,000. So anything you see here in yellow is an updated total. I didn't total any items like unearned revenue that only have one thing, wages payable. There's no need to total that. It's already there. But anything that had more than one, I went ahead and put it in yellow just so I know that that's the total for that particular key account. And then the second thing I always want to do is add up all of my assets. So I add up my cash, my account receivable to Steve, all the way down through the equipment, and subtracting my contra account, the accumulated depreciation. And that gave me a $28,200 asset. And hopefully when I'm all done, this side of the equation will also equal $28,200. So I add up my liabilities, all of my totals. Owner's equity, remember you take your capital minus any drawings, because the drawings is a contra. Revenue is simple to add. And then add up all of my expenses. And of course we're going to subtract that when doing the equation. And so if we add up the first three and then subtract out my expenses, I do get $28,200, the same as my assets. Now the last thing that I want us to be able to do at this point in the semester is to take all of this information, all of these updated key accounts, and provide a brand new adjusted trial balance. Because what we were given originally was unadjusted. It didn't have these corrections and adjusting entries. For example, it still showed account payable to Julian for $300. It's not. It's really $1,300. And that's what my new adjusted trial balance is going to show. For example, the $1,300 to the account payable for Julian. Notice there's no need for me to put any accounts that were zeroed out, such as the prepaid advertising. I don't need to put account 121 here because it's gone. It's zero. And all of my T accounts are now in proper order. This is a good summary of all of my T accounts with their brand new final balances. Notice I call this the adjusted trial balance. So all of my accounts are in proper order. My debits, when I add them all up, do equal my credits. So that helps me know that I'm on the right track. And I also put out here to the side what I had already did in my T accounts. Kind of a summary of what my total assets were when I added everything up except subtracting out my accumulated depreciation. Adding up my liabilities, when you add all those up, you should get $6,800. Dividends and drawings, or my capital and my drawings are dividends. And then when you combine everything, you still get $28,200. I hope that helps clear up a little bit with adjusting entries, correcting entries, and now our fourth step here is the adjusted trial balance. My next video will look at the Wiley Plus for this week, where we do look at some correcting entries. We'll look at mainly adjusting entries as well. So with that, we will break off and start a new lecture video with the Wiley Plus.